The Federal Reserve has shocked the financial world by making their intention clear to crash the housing market and the stock market simultaneously and bring the global economy down to... What's that? Tone it down a bit? I know, but they said... All right. The Federal Reserve announced this week that they expect it will soon be appropriate to raise the target range for the federal funds rate and released a paper outlining principles to start significantly reducing the bond holdings on its balance sheet. Looks like the party got too hot and the Fed is taking away the punch bowl. The days of easy money are coming to an end and markets don't like it one bit. Welcome to a sobering dose of reality. Can the Fed bring down the highest inflation in 40 years without taking the economy down with it? Let's get into it. As inflation is running hotter than it has in decades with no indication it will do anything but head higher in the short term, the Federal Reserve has found itself between a rock and a hard place. As they pivot to tighten monetary policy, they run the risk of causing a recession, and it hasn't even been 2 years since the last recession. They're making plans to raise interest rates, stop the money printing, and start selling off their massive bond holdings. These are the tools they have to rein in inflation. Right now, we have too much money chasing too few goods, the classic recipe for higher prices, and they are basically going to reduce the amount of money out there and give the supply of goods and services in the economy a chance to catch up. However, by using policies that are essentially used to reduce spending, they risk overdoing it and causing recession. Some of the most direct and immediate impacts will be seen in the stock market, bond market, and housing market. Let's take a look at each one of those and how the Fed policies are likely to impact them. First up is the stock market, and we've been seeing an impact already with markets going on a wild ride the last few weeks. The stock market is typically forward-looking. Investors look at what is expected to happen in the future and they adjust their investments accordingly. In this case, the market is expecting the easy money to end soon, so investors are selling ahead of it, sending the major indexes down. We saw this back in 2016 with the end of the quantitative easing program, aka money printing, that the Fed started after the Great Recession in 2008 and 2009. Back then, the S&P 500 fell 14% from May 2015 to February 2016. However, this took place in the midst of some other global events taking place, like slowing growth in the Chinese economy, the Greek debt default, and falling oil prices that led to a global sell-off in equities. So the declines weren't only because of the end of money printing. That being said, we're dealing with a lot of headwinds in our current time as well, such as a pandemic that brought the global economy to a halt less than 2 years ago, and slowing growth in China and many countries reaching record high levels of debt. So while the two time periods are not directly compatible, let's see how the stock market has performed since the Fed got serious about tightening monetary policy. From the recent peak back in the beginning of January, the S&P 500 is down 9% through January 26. So there's certainly room for it to fall more if the Fed got aggressive and wound down their easy money policies in short order. One problem, however, is that the current economic environment is much different than the last time the Fed turned off the money printers. We did just get some good GDP growth numbers this week, 6.9% for the fourth quarter, which beat Wall Street's expectations, but our labor market is much weaker than in the prior period of tightening monetary policy. We still haven't recovered all of the jobs lost during the last recession, and the labor participation rate is lower than it was during the last period of Fed tightening. In fact, it's the lowest it's been since the 1970s. Inflation is a big problem as well. Back in the second half of 2015 and the first half of 2016, inflation averaged less than 1%, and people were more worried about deflation as the Fed couldn't hit their 2% target despite their money printing and historically low interest rates. Back then, they had a healthier labor market and benign inflation, so they could slow down their tightening as the stock market protested. But now they may have to get aggressive with the tightening of monetary policy before inflation gets too high, and they will have to push up interest rates to record high territory to bring it down, as they had to do in the 1980s. Next is the bond market, and we've already seen yields on the 10-year Treasury bond moving higher since the beginning of January amid the Fed making clear their intention to tighten monetary policy in 2022. Given that bond yields and prices move in opposite directions, what we're actually seeing is falling prices on bonds. So if the Fed is in a situation where they have to raise interest rates aggressively to fight runaway inflation, they will essentially be causing a crash in bond prices. One of the dangerous consequences of that would be the effect on the housing market. Ultra-low mortgage rates fueled much of the boom in home prices the last few years, and buyers took advantage of a historic opportunity to lock in a 30-year loan for less than 3% in some cases. Rising mortgage rates could significantly sap demand for new homes. In a video we did last year, we took a look at housing affordability and whether we are getting into a range where prices were so unaffordable, on average, they had to come back down. We found at the time they weren't in that range yet, but a lot of that was because mortgage rates were so low. Here's where we stand now on affordability. This is an estimate of the average housing payment share of median household income, which includes loan principal, interest, and property taxes. This is as of December, when mortgage rates were about 3%. We're still seeing housing payments trending higher as a share of income, but on average it still isn't above 30% nationwide, which is a general rule of thumb that represents a household is cost burdened by their housing payment. Back in the previous housing bubble, you can see the average share of income nationwide reached over 35%. It just wasn't sustainable. But now let's look at a hypothetical where mortgage rates were just 1 percentage point higher and all other things stay the same. Now we see housing share of income going above the 30% level, but it still doesn't return to where we were in the last housing bubble. Now, if mortgage rates were 2 percentage points higher in this hypothetical scenario, we get back to that previous peak at around 35% of income, and that's with mortgage rates at just 5%. Back in the 80s, when the Federal Reserve had their last serious battle with inflation, mortgage rates were up to 18%. Compared to that, a 5% mortgage rate doesn't sound too bad now, does it? Stay tuned to our channel over the next few weeks as we release our next video in the series, When is the Housing Market Gonna Crash?, where we're going to take a deeper dive into what higher mortgage rates are going to do to prices if things play out the way it looks like they will with the Fed's current plans. Needless to say, the Fed has a delicate balancing act to pull off. They can either tighten monetary policy or risk inflation getting even more out of hand. But tighten too much and they will crash markets and drive the country back into recession. We'll be watching all the developments as they happen and assess the dangers to markets and the economy as we go along. Make sure to subscribe. Hit that notification bell down below so you'll know right away when our next video on the topic comes out as we monitor the situation for you. If this video has been helpful for you, please give it a thumbs up to support the channel and help us grow. Thanks for stopping by, and I'll see you in the next video.